For some reason, my views on charting and technical analysis are quite controversial in the retail trading space in particular. And so I thought it's worth a go to explain even a bit further of why charts don't help scalpers or in fact traders of any kind. Let's have a look at a typical chart, a bar, and this is our open, high, low, close bar. We have an open of 15, a high of 15, a low of 14, and the closing price of 14, and a volume of 100 lots here. And for the purpose of this discussion, it doesn't matter if it's a 1 minute bar, a 5 minute bar, or even a 1 day bar. That's the activity that we see. So if I'm using the chart and I'm a chartist, what can I deduce from that bar? Well, I can see that the open was 15, the high was 15, the low was 14, and it closed at 14, and the volume was 100 lots. If I asked you, is there any edge in any of those prices or any of that information, can you see where any edge is there? I must say I can't see anything in that. It's just some information. Technical analysis traders will often use the closing price as an indication of direction or as a trigger for getting them into a trade or out of a trade. They believe that's the final resting place for the market for that session, and they tend to overvalue and overweight that price. So you'll often be taught to trade on a close of a certain level rather than where it's traded intraday. So there's that bar. But what if the trade on that particular session was made up of this type of trading? The opening trade is at 15 and it's 5 lots. Then the market trades 14 on a 10 lot, 14 again, 5 lots, 14 again, 14 again, 14 again, 14, 14 at 20 lots, 14 at 10 lots. Closing price is 14, overall volume's 100. What if the market traded that way? Can you see some more information? Does it tell you more about what's happening in that market? What if the market traded this way? Opened again at 15 and a 5 lot, then trades 15, then trades 14, 15 again, 14 again, 15 again, 14, 15 and 14 finally. So the closing price is 14. That also creates the same bar, the same volume. Is it the same market as the one we saw previously? What about this? Same bar. Opening price 15 in a 10 lots. Then trades 15 again. 14 trades small in a 5 lot. 15's trade, 15's trade, 15's trade, 15's trade, 15's trade. And then finally a small trade at 14, which is the last price, the closing price. Volume again's 100. The same bar opens at 15, closes at 14, trades 100 times. Is that the same as the last two? The bars on the charts are the same, but they can have multiple possibilities behind them. The chart creates a shortcut. It's a place where information is put into easily digestible ways, but they do not tell you the whole story. They do not tell you how the contract traded. One of the key problems is that charts plot data on a price versus time basis, but markets don't operate on a time basis. Markets operate trade by trade. So traders, if you want to make better decisions, you need to be able to watch them on a trade by trade basis. And this is even more critical for short-term traders such as scalpers. If you trade off the charts alone, you will miss significant information. If you can't see the information behind the chart or the bar, then anything you deduce in your analysis will be less reliable. This all comes under the topic of context, which I discussed in another presentation on my YouTube channel. Understanding context is vital to making better trading decisions. And again, the example I gave is the Winter Olympics. I think it was 2002. Stephen Bradbury, Australian speed skater, who in the final was in last place coming into the last lap. The first three guys all fell over. They collided and fell. He came around the outside and got his gold medal. Now, if that race was being rerun the next day, and we had two bookmakers having to make a price on who was most likely to win, one of those guys had watched the race, one of them just saw the result. Who's going to make the better price? The one who watched it effectively is like us watching a market trade by trade. He knows Bradbury run, but he also knows that that's unlikely to happen again. He was in last place right up until the end, and it was only because everybody else fell over that he won the gold. The guy that looks at the result, in this situation with trading, he just looks at the chart. He sees Stephen Bradbury's the winner, so therefore he will make him the favourite. That's like looking at the closing price. The closing price is like looking at the final result. Technical analysis places a lot more value on closing prices, but this is unreliable. In the markets I've worked in, and I've worked in a number of them over the years as a market maker, most of the biggest trades occur before or on the open. That's when the big traders are trading. The close tends to be where traders are rushing around trying to cover losing trades, and or they're sort of trying to move the closing price around to help their P&L for the day, or perhaps for margin requirements. Just making for example, a futures contract, if you can get it closed a couple of ticks differently, it will affect your margin. So people are running around trying to do all sorts of silly things on the close. Learning not to place much value by closing prices was a valuable early lesson for me, and I explain exactly how and why I learnt that lesson in my book, An End to the Bull. So to summarize, charts will offer you a shortcut. That's all they are, a shortcut. They do not show information in the way that a market actually trades. Markets operate trade by trade, not minute by minute or hour by hour. So when I trade and when I teach traders, it is vital to understand what's really happening by learning how to understand trade by trade data and context. It's not easy. It's more difficult than trading off a chart initially, but it leads to better decision making and a better understanding of where a trader can find edge. And again, if we go back to our bar, our simple bar, if you knew how this bar is made up in any of these three different situations, you've got edge over someone that just looks at a chart. So I hope that explains it a little bit more. And as always, would always welcome feedback. Thanks for watching.